You've probably seen some headlines and some tweets saying that because the Dow is up, the economy is doing great, and maybe over the last couple of months, the opposite of that. But you've probably also seen that due to the pandemic, we've reached truly historic levels of unemployment. And yet, comparatively, the stock market seems to be doing not too bad these days. So, what gives? You're watching Future Now, stories about the future of tech and society. As the title of the video says, the stock market is not the economy. And I definitely can't change the title of this video now if the algorithm hates it. But you've probably heard that phrase thrown around a bunch. But you may be wondering, then why does the media cover the ups and downs of the market so closely and make broad statements about how the country is doing financially based on it? Well, to understand what it isn't, we should probably understand first what the stock market actually does represent. And just as a disclaimer, I'm not an economist or a financial expert, so I'm going to talk about this stuff in a pretty surface level way. Put simply, the stock market represents all the buying and selling of shares in companies and the places in which that buying and selling happens. It's not efficient to track every single stock in the stock market, and so usually when people are talking about changes in the market, they're talking about changes in an index. An index focuses on a particular group of companies to represent the stock market as a whole or to represent how a particular industry is doing. Companies put shares of their company up for sale on exchanges like the New York Stock Exchange, and when you buy a share in a company, you basically own a piece of that company. And generally speaking, when a company is doing well, the value of that share goes up. And when a company is doing poorly, the value of shares in that company goes down. So basically, the price of shares change depending on how much people are willing to pay for it. So really just supply and demand. There are analysts that look at what's going on in the world and in companies and make predictions based on that to see how it's going to affect the stock prices. And that tends to actually drive changes in the stock prices. This could be anything from a new corporate tax policy and how it's going to harm or benefit a company, let's be honest, probably benefit, to whether or not the CEO just got caught doing some terrible thing, or whether there's a global pandemic happening, and occasionally whether the products and services of a company are actually any good. It's very easy based on all this to believe that if the stock market, that is the perceived value of groups of companies, is doing well, then the economy must be doing well. But the truth is that the economy has way more factors going on. It's every product being produced, bought, and sold. It's wages of workers, it's unemployment numbers, it's taxes, and on and on and on. And yet, knowing all this, I can still relate to this video from Graham Stephan.
What's up, you guys? It's Graham here. So the other morning, it was really like any other. I woke up around 6 a.m., I went to the kitchen, I got myself some coffee, I sat down in front of my computer, I took a sip of said coffee, and then I literally spit it back out when I saw that the unemployment number saw a 3,000% jump, with 6.6 million people claiming unemployment. And of course, the stock market reacts on such a devastating day like you would expect it to, by going up in price by 2.28%. Like, I can't be the only one who finds that very odd, right?
Right. And if you watch Graham's videos, then you already know what to do. Wait for it. Obliterate the like button for the YouTube algorithm if you haven't done that already. I've always wanted to say that. Anyway, so let's take a look at why millions of people suddenly filing for unemployment may not affect the stock market like you'd expect it to. About half of US households own some stocks, usually through a retirement fund like a 401k. But the vast majority of stocks, 84% of all stocks, are owned by the richest 10% of Americans. In fact, a whole 40% of household stock holdings are owned by the top 1% of Americans. That's people with a net worth of over $10 million. So you could say that the stock market represents the economic state of the richest Americans, but it by no means represents the economy as a whole. And that's the fundamental problem with using the stock market as a compass for how the economy as a whole is doing. At a moment when millions of people have lost their jobs, more than at any point in American history, including the Great Recession and the Great Depression, the stock market is essentially at an all-time record high. The stock market has fallen, but it's basically already recovering. The average worker isn't really affected by the performance of the stock market, unless they're just about to retire and therefore retrieve funds from their retirement fund. What should be more worrisome to the average worker is that as the stock market has achieved record high after record high over the last decade, wage growth has barely kept up with inflation over the last several decades, especially for workers who are now deemed essential, who by and large receive minimum wage. So most of us don't really need to pay attention to the headlines about the stock market. But if you are in the top percent, please check out my Patreon page. I think I may need more stuff on this wall. It's a little bit blank right now. Wait for it. Obliterate the YouTube algorithm for the like button if you haven't done that already.